Live. I'm Keith Knapp. I'm going to be guiding you through our wonderful training on the three major red flags to avoid when getting a business loan. But before we jump into it, if you're interested in getting a business loan, join us on February 14th at 1 p.m. Eastern Standard Time, as we're going to be, as Ty is going to be covering in all of the small business loans available in 2023. You can register for that for free at creditsuite.com/loans23. And we'd love to have you. It's going to be a great time. We always, Ty always has a lot of fun on those. One of our extended trainings that he spends a lot of time answering questions and making sure you guys are taken care of. And as you guys are joining me today, give me a hi. Let me know where you're from and share your information, your company, what type of business you have on here. We'd love to say hi. Gina on Facebook says hello. Hello, Gina. Hope you're having a wonderful Tuesday. All right, let's jump into our training here. So the question is that you need to be asking, if you want to get a business loan, who can you trust when you're looking for a business loan? Access to online lending has gotten way easier, and I mean, honestly, anymore, every time you turn around, it seems like there's a new fintech company popping up. There's a lot of companies that just seem to come out of nowhere. You know, they watch some trainings. They think they're experts now because they do. So what we're going to do is we're going to be talking about like what to look for in a lender, what you need to do, how do you know that you can trust a business? Because at the end of the day, the one question that you need to be answering, or they need to be able to prove to you, is, are they legit? Is this a company that you can actually trust with your financial information? Are you going to get the best loan? Are you going to get a loan that's not going to just leave you high and dry and stranded and put you in a worse position that you may be in now? So let's talk about some of these red flags to look for. It's important to know how to spot a fraud. At the end of the day, when you start getting into business loans or you start getting into financing, you start diving into things that maybe you're not super familiar with. It can get overwhelming because they're going to say the right things. I mean, every business has great salespeople that know how to say the right lines, that know how to overcome objections, even if it's not the best products or services. So what you need to do is you need to have an outside filter of being able to look at this and go, hey, is this company fraudulent? Are these people that I can actually trust, that I'm going to get something decent? And part of that is it's going to cost you time, money, and maybe even more if you're not careful. Getting into a bad loan can cost you thousands and thousands of dollars. It can take years to recover from, and I mean, ultimately, it could have the worst impact of losing your business. And if there's a personal guarantee tied to it, now it's impacting your personal family finances. So you need to be careful with who you're working with. And you have to know how to find what you're really looking for. And part of that process is to understand what a good business loan looks like. You know, there are some things as you're getting started in the business lending journey that you are going to have to anticipate. Like, you know, if you're just getting started, not many, if anybody, is going to just come out and go, hey, I'm going to give you millions of dollars for an idea that you have. You have to progress in your journey of getting business loans. So you know, as you're moving through this process, that one thing to understand is know what you're really looking for. And Lucky on Facebook says, "Wonderful Tuesday." Absolutely, I'm in Kansas City. Go Chiefs! We in another Super Bowl. But the weather is actually 60 degrees out here now, and it's beautiful. It's fabulous. It's Everybody's just outside walking around. Dogs are everywhere, but don't worry, it'll get back down to 20 tomorrow, I think. So, all right. So let's talk about some of these red flags, and we're going to dig in on this and start talking about it. Before I jump in, Brenda on YouTube says, do you still do a free scan to see why I might be getting denied for any business credit that I applied for? Credit cards are supposed to be easier to get than I keep getting denied. My condolences, go birds. I'll let you have that one. Brenda, yeah, absolutely. We can help you with that. It's at creditsuite.com/consult. We'll get that in the chat for you real quick. We'd be more than happy to look at your information, see what's going on, see if something's happening. And the Eagles may win. They look great. The Chiefs look great. All I know is it's going to be a lot of fun hanging out with friends and family watching the Super Bowl. Let's talk about the red flags that are unmistakable when you're applying for a business loan. High interest rates or unrealistic terms is probably my number one red flag that I look for. And not all high interest rates are bad. Not all unrealistic terms are bad. When you're getting into the process of looking for financing, sometimes when you dive into like the three C's of cash, credit, or collateral, if you don't have all three of those C's, if you don't have consistent revenue or you don't have collateral to be able to secure a loan, interest rates can typically be higher. But what you want to look for is and we'll dig into this a little bit more. I'm jumping ahead of myself. I'm getting excited about this stuff. The next thing you want to look for is a prepayment penalty. Is it going to cost you money to do the right thing and pay off your business loans? Are they going to try to make sure that you're stuck in a loan longer than you really should be? And then the last one, and this is one that I've personally seen from lenders. Rates and fees are not what was disclosed, and unlike the consumer lending, I have a lot of friends who are loan officers, and like the requirements that they have to go through to disclose if there's any sort of rate adjustment is just absolutely it's almost ridiculous. But for consumers, it's amazing because there's no hidden fees, there's no hidden rates. Like when you get there to sign, you know what it is. Business loans, not so much. Rates and fees are not, if they're telling you one thing, you get to closing, you get your documents, you go to sign them, and you realize that the rates are higher, the fees are higher. This is definitely a red flag that you want to look out for. So let's dive in on these topics and discuss them a little bit more. So the first red flag that we're talking about today is high interest rates or unrealistic terms. And one thing before we jump into this, and I'm going to take a step in because I think this is important to understand. You may look at these and go, oh, I'm in a high interest rate now, high interest rate loan now, or hey, I have a loan that has prepayment penalty. Just because a business loan that you're looking for has one of these things, maybe even two, depending on your financial situation, doesn't mean that the business itself is fraudulent. It may be more of a subprime lender or an alternative lender that has looser guidelines, that's willing to take that risk because of the higher fee. But really, overall, what you're looking for is you're comparing it to industry averages. So, for example, if you're looking at cash flow financing, you get into interest rates or unrealistic terms, and you start shopping around. You look at three or four different lenders, and you realize this one that maybe has the best salesperson has a much higher interest rate terms and worse terms. That is a sign right there that the other ones that you're comparing it to may be more legitimate than the one that looks better. So that's something that you need to keep in mind, is that not all of these in and of themselves are inherently bad or evil or dictate a red flag for a business loan. But when you start comparing it to what else is out there, the other options that are available, that's when you really need to be keeping an eye on the lender, or you just have that really hard decision of, do I actually want to work with this company? All right, I'm done with that rabbit trail. Let's get to red flag number one: high interest rates or unrealistic terms. High interest rates or unrealistic terms. Lenders that offer loans with interest rates that are significantly higher than the industry standard versus similar products. As I was just talking about, one thing that you want to do is when you're looking for a business loan, don't just take the company at face value, especially if you're going directly to the lender. If you're going directly to the lender and they're coming back to you and they're going, hey, we're going to be up here, and you're not comparing to everybody else, you may be paying 2, 3, 4 points higher. Because one thing to understand is that a lot of lenders, what they're doing is they have so take a step back here. When you're looking at lending, there's a lot of different ways that the banks collect money or lenders collect money. They may have private money from investors that are coming in. They may actually be kind of a white label front for a larger company or for another bank, and so they're getting paid money based off the rate that they're charging you. So they may be upping that interest rate to be able to make more off of you as the borrower. And then you have some that are just hard money lenders. The investors that they're working with are requiring that they have high rates. But overall, what you're doing is you want to take a step back and compare it to industry standards. what is standard for the type of loan that you're getting. And to understand the industry standards, you have to look at it not just from, hey, you know what, I'm going for this cash flow financing and it's telling me 9%, but SBA is down here at 5%. That's not exactly the same industry. The only thing they're really sharing is the name business loans, but they're two completely different financial instruments, two completely different types of loans with different underwriting, different qualifying criteria, because obviously a cash flow financing is going to be way easier and faster to qualify for than an SBA loan. But when you're looking at that, you want to compare it. Okay, you know what is how is 9% for a for cash flow financing? Is this a good rate? And I think what you're going to find is if you find somebody at that, that's a really good term for cash flow financing. But this is what you want to look for. You want to compare it to similar products in the industry, similar financing options to be able to figure out, is this loan actually legitimate? And if you're working with a lender that you like, sometimes it's not going to hurt you to go check with other lenders just to compare, just to see, just to make sure that they're actually giving you the best loan and that you're doing it. And a little secret on that is that if you do find it, you can negotiate with the lender, because here's the thing: the terms of the loan, how long you're going to pay for it, all of that stuff, your interest rates, that happens before you sign the loan. After you've signed the loan, it's just kind of it sits in a portfolio. They send automated mailers. I mean, it's not, they don't have any impact on the terms of the loan after the loan has been signed. So you can actually negotiate your rates and terms as you're moving forward in the process. And we've done trainings on that before. Ty actually did one, I think, about 2 months ago that was really good. Went pretty in depth in the negotiation process. While you're going through it, just keep an eye out, look for it, and then if you feel like it's a lender that you really want to work with, try to negotiate lower terms. It happens. It's okay. It works that way. Next, unrealistic repayment terms can drown you in payments. And when you're looking at terms, some of the terms that you want to look at is you want to look at how long, what is the length of this loan? Because if you're looking at a loan that's got a 60-month or a 5-year loan amortization opposed to a 10-year loan, I mean, obviously the 10-year loan, I mean, anytime you have longer amortization or a longer term on the loan, the rates actually go up, which is like in the consumer world, if you're looking at like a 30-year mortgage and you start looking at some of the newer, the 40 or the 50-year mortgages, which is just way out there. That's when you're looking at those, you have to keep in mind they're going to charge you more interest for the terms of the loan. And it's the same thing with business loans. The longer the term, usually more consistently, the higher the interest rate. But is it an unrealistic repayment terms? Is it something that you're looking at going, man, I need this longer than a year. I need 2 years. I need 5 years. I need 10 years. Keep that payment term in mind, because sometimes what lenders will do is they'll hide a higher interest rate with a lower term, meaning that instead of a 5-year loan, they may give you a 4-year loan or a 3-year or a 6-month loan in some cases like merchant advances, things like that. But what you need to do is not just the interest rate, but you're also looking at how long are you going to be able to do this, because that is going to have a direct impact on how much money you can actually borrow and how much you can actually afford to have with that loan. Because the longer the term, the lower the payments, means you can borrow more money and keep your payments down. And if there is a PG, it can take your personal finances as well. One thing to keep in mind is if you're looking at a business loan and you feel even a little bit apprehensive about the terms and the rates, and you look at this and you're like, man, there's a chance that the company is not going to survive. There's a chance that we're going to hit economic downfall. Understand that those rates and terms, just because the business defaults or the business goes out of business, if you have a personal guarantee on that, they're still going to be charging you that interest rate, even if the loan has been charged off, even if you're late or you're behind on it. And that rolls over to your personal finances, has a massive impact on you. So if there is a personal guarantee, just make sure that you're careful with it, that you're watching yourself, and that you're finding rates and terms that can be manageable even for you if you have to go back into the workforce or pick up a job on the side, or however you need to recover from any setbacks inside of the business. All right, red flag number 2. Let's talk about prepayment penalties. Way back in the day in the 2000s, in the zeros, I was a loan officer, and that was the days of subprime lending when prepayment penalties were on there. So like you talk about prepayment penalties, and like just my knee jerk reaction goes up from my past experience with it. Lemuel on here. Good day. Hey, Lemuel, great to see you. Hope you're having a wonderful day. All right, so prepayment penalties. Let's talk about this. Prepayment penalty is a fee that's charged if you pay off a loan before an agreed upon time. So, like in the first red flag that we were talking about rates and terms and how that could actually be a red flag and have an adverse impact on you. Now, consider this: if you get, let's say, you get a loan with a higher interest rate, and that interest rate and that interest rate um, and that interest rate is locked in and you have a prepayment penalty on it. That means that if you pay off that loan early, and they can actually charge you a portion of the interest that they would have made. Usually, you find this on like a 2 years or 3 year term, and a lot of that is going to be able to. A lot of that's actually going to be able to. A lot of those. A lot of the prepayment penalties. Man, I'm sorry, I was reading the chat. My brain I just completely, the train just went completely off the rails there. But prepayment penalty is a charge for the loan. Yeah, it's how lenders make their money. And one thing that you want to be careful of, especially if you're looking at higher rates and terms, is don't get stuck. I know where I was going. But the other thing to look at with prepayment penalties is you have to look at what type of loan that you're going to be getting. For example, like if you're looking at real estate, you find and you're working with a lender that's going to help you as a startup get something that's like a buy and hold or an acquisition strategy, such as like Airbnb, or you're looking at commercial lenders, things like that. Having a prepayment penalty on a loan like that is actually pretty common. Opposed to the flip side, if you're looking at like a fix and flip, you want to avoid the prepaid penalties at all costs. Those prepayment penalties, like on a fix and flip loan, that's designed to be a 3 month, 6 month, worst case, a 9 month loan that you get in, you rehab the property, you turn around, you make money on it. Having a prepayment penalty on that loan is not going to do anything else except take your money. So one thing you just be cognizant of if there's a prepayment penalty, and then consider, what kind of loan is it. If it's a real estate loan that's a long-term buy hold strategy, obviously having a prepayment penalty on it's not going to have near as much of an impact as short-term financing. But the thing I hate about prepayment penalties, it's like they're penalizing you for being responsible. It's like you get out there, you start making money, company, yeah, you get a loan, you just get some critical mass, you start making, you're making much better money. You get to a point that you can pay it off, and it's like the bank's like, hey, I know you're trying to do the right thing, but you know what, pay us some extra money for being responsible. It's just one of those things that you I understand it's there. I understand that banks need to make money, lenders need to make money, but I feel like you should never be penalized for being responsible, for doing the right thing, for paying a bank their money back. It is what it is. It's just, I'm not here to judge it. I'm just here to talk about it. So, but a prepayment penalty can get you trapped in a bad loan. And that's one thing you want to avoid, especially if you're looking at these other two red flags. You have a high interest rate, you got bad terms, now you got a prepayment penalty on it. It really puts you in a no-win situation. And that's what some of these predatory lenders are looking for. Is they're not afraid to take advantage of small businesses that are looking for money, get them that money, and then put them into a position where they really feel like they're trapped and they just can't get out of it and they can't do anything with it. And that's what you need to be careful of, and that's why we're discussing this. And at the end of the day, it can cost you thousands of dollars that you don't need to be spending, that's unnecessary for you to spend. So take the time, understand your prepayment penalties. If there is one, see if you can negotiate yourself out of it. Especially if it's something that you're planning on it being more of a short-term loan, it could save you a lot of time, could save you a lot of money with it. All right. Oh, this was supposed to be number 3. Sorry about that. But red flag number 3, rates and fees are not what was disclosed. To me, this is kind of the kiss of death. because this is you don't find this out until you get to closing. So like as you're going through the process, you've gone to the website, you've talked to the lender, you've looked at their terms. They've sent you over a proposal most of the time that says, look, here's what it is, here's what the loan looks like, here's what your rates are, here's how much you're going to owe us for it. To me, at that point, when you sit down at closing, you've had enough conversation with the lender to know exactly what you're expecting to be getting. And so if you go to a lender and their rates and fees are not what was originally quoted, that's some bad news. And now the caveat to that, and every time you're talking about anything like this, you're always going to have some caveats. But the caveat with that is right now the feds have been messing with the rates all the time. They're just constantly they're just up and down a lot right now. So that does happen. But the first thing you can do is always keep track of what was originally quoted to you. Don't just hope that you remember. Keep the documents. Looking at what look at what's going to be available to you. Look at how it's going to work for you. But always keep track of what was originally quoted. Next, watch out for changes in the interest rates. Lenders make money off the higher interest rate. Again, that's one of the, I mean, interest is nothing more than the bank's way. Interest is the instrument that banks make money off of. And in fact, it goes so deep that the bond market is actually based off of interest rates that are being sold to through credit card companies, through business loans. When people are buying bonds, they're buying interest rates of performing portfolios, meaning that like a Wall Street can look at it and go, you know what, we've got 10 loans here that equal about $10 million. So they package this into a $10 million package. And then you buy into that. When they're putting that together, what they're using is they're using the note as a security instrument to be able to secure that money that has an expected return over the next 5, 10, 15, 20 years, whatever the terms are. So what they're doing is as they're going through that, that money that the investors are making money, the banks are making their money back, and they're keeping a portion for the servicing. So I know way too much about this, but as part of the fun, that's why you're here, right? So, for example, what happens is, like, let's say you go to BOA. BOA, you go to them, you say, "Hey, I need a business loan." They say, "Great." They charge you 7%. They get you a pretty decent loan because you got your cash, credit, and collateral all intact. Your fundability looks good. And they're like, "Great, we're going to give you a 7% loan." Now, when they're putting that money on the secondary market, what's happening is they may be paying a 4% return or a 3.5% return, meaning that out of that 7% rate, if they're paying 3.5% return for somebody buying that money, they're still keeping that other 3.5% for servicing and for profit for the bank. So what they're doing is they're recovering the money that they've already loaned you from the sell of from the investment on the interest rates, and then they're making money off the servicing as well. So when there are higher interest rates, banks are being paid more money. It's how the banks make more money. And like I'm not going to say you should just walk away from a deal if the rates aren't what's disclosed, especially if you have a lender who's really trying to work with you and communicate. But if you don't hear from anybody and all of a sudden you sit down and your interest rate is considerably higher, like I wouldn't hesitate to walk away from that, because that's somebody trying to take advantage of you. That's somebody who's trying to get you to that point because they know that your psychology is you've been approved, you've been through underwriting, you're getting ready to get the money that you qualify for. And so for you to walk away is a big deal, especially if you're looking at like an SBA loan or something that may have taken 30, 45, 60 days to be able to get to closing. You walking away from that is not likely at all. So they know that sometimes they're going to be able to actually come in and give you that higher interest rate, and you not even do it, and you not even walk away from it because they know you've already have plans for that money. You're already thinking about what you're going to do with it. So watch out for those changes in the interest rates. It's a big thing, and then check out for unaccounted fees. At the beginning, with lenders, get a copy of what the fee should be. Get like a good faith estimate of how much is this going to cost me? How much money am I going to spend in this? How much are you charging me? How many points are on the front? Are these points doing anything like effectively buying down the interest rate? And just understand what fees that are on there. because as you get into business loans, there can be a lot of weird things that you don't understand, and they kind of count on that. I mean, it's not uncommon for banks to have junk fees in there that's just extra money going into their pocket. So always keep an eye out for the fees. If you can get it in writing up front, get it. If you can't get it in writing up front, maybe you should consider, is this a bank worth working with? Because if a bank's not willing to give you and to accurate or to just transparently disclose how much they're charging you up front, how much a loan's going to cost you, what else are they hiding from you? What else? How bad is this transaction going to go? And then from there, how are you going to know if you're actually being taken advantage of, or if this bank is and this lender is doing the right thing? So get your fees, understand them, look at them. If you have any questions, sit down with the lender and negotiate. Negotiate the heck out of a loan. Try to get the best rates, the best terms, lowest fees that you possibly can. There's nothing wrong with that. That's part of the game of lending, is for you to be able to take advantage of that. And then at the end of the day, is there any satisfactory explanation to why there's a difference? Again, if you have a lender that's communicating with you, it goes a lot further than the lenders who are just trying to put this stuff out there and not talk about things, not talk about it with you, and just hope that you close because you really need the money. So rates and fees that are not. So how do you find the right loan? The quick and easy way is schedule a free business financing assessment with us. Find out what loan you can qualify for. Look, we have hundreds of lenders that we've talked to. When I'm giving you this information, the reason I'm giving it to you is because this is exactly what Credit Suite does. We go through and we look at all these different lenders. We compare the rates, the terms, the fees, and figure out what exactly is the best for our clients. What is going to be the best loan for you? What are you going to get from it? And then we're going to help you find that right lender. You can schedule a free financing assessment at creditsuite.com/consult. We'll sit down with you, figure out, is your fundability intact? Meaning, is there anything that's going to hold you back from getting financing for your loan? Do you have your business credit ready? Is everything there? And then we're going to tell you, look, here's what you can qualify for based off of your situation right now. But then we're also going to look at it with you and go, what else can you do so that in the next 6 months you can qualify for a better loan or a different type of financing? You can start stacking. We're going to help you think through all of that with all the different strategies. So sign up for a free business financing assessment if you have questions, if you want to see why you're being turned down for business loans and business credit, like what Brenda on YouTube was talking about earlier. This is where we can help you out with that. And if you want to just explore different ways to be able to get business loans, you can go to I've got to show the link here. You can go to creditsuite.com/27 to download our free guide on 27 killer ways to get cash for your business. That's at creditsuite.com/27. Cool thing about this is if you're just kicking the tires, you just want to see what options are out there, what's available. This is a great way to just get your feet wet, get yourself introduced to the world of business financing, world of business lending, find out what options are out there so that you can start looking at it and figure out what's going to be the best option for you. And that's all I got for you for today. If you got value from this, make sure to share this. Do me a favor, comment, give me a like, give me a subscribe, and share this. If you share this with hashtag Business Credit Toolbox, we'll get you a bunch of free tools to help you build your business credit for free. It's our way of saying thank you for helping us achieve our goal of helping as many business owners as we possibly can find the financing that you need to succeed. If you have any other questions, make sure to give us a call at 877-600-2487, creditsuite.com, and make sure you go to all of our social channels. Click the like and subscribe. We love our audience. We'd love to make sure you guys are taken care of. Hope you have a wonderful Tuesday, and let's go Chiefs at the Super Bowl. Yes, I'm looking at you, Mr. Facebook user, who gave me your condolences, and we will see you guys